Equity management. You knew it was coming, folks. And here it is, the section on equity management, where I tell you to change what you're currently doing. Before we get into the details on that, we're just going to have a look at a bobsled picture here. And what's important about this picture is this. Here we're at the top of a track in Germany, and in this particular race, we were in third position. A World Cup is two heats, and after the first heat, we were in third place. We were in bronze medal position. We weren't far from first place, but we were also not far from sixth place. Now, when you stand at the top of the track, or when you take this time out between heats, you can either think about actually the winning of a medal. You can think about the end result, where you think about how nice it would be to win a medal, how nice it would be to have that medal around your neck, and that it's another addition to your fine collection, and what fun you'll have after the race, that we've all won medals, and just we can think about the performance bonus money as amateur athletes, which of course is hundreds of dollars rather than millions of dollars. But we could think of all the fine things that come with winning. But that's not going to win you the race. What's going to win you the race is focusing on the task at hand, focusing on the finite details and the execution of the task, and focusing only on the details of the task. Because if you focus on the details of the task, the end result will take care of itself. As in trading, if you focus on your understanding of the market, broadening your understanding of the market, proper and effective application of the tools, and being flexible with the market, but being disciplined in your equity management, then the money will be deposited in the account as a consequence of focusing on the task and doing what you discern as best based on your broadened understanding of the market. And on this particular occasion, we moved up by one place to second place, but it was a very, very close race nonetheless. An error doesn't become a mistake until there is a refusal to correct it. Now, you may enter into a trade and take a big, big loss. And you may take a big loss because you risked too much on that trade. And maybe you learned a lesson. But you don't want to learn from experience that you have not learned from experience. And an error doesn't become a mistake until there's a refusal to correct it. So the next time, let those one or two lessons of big losses be a lesson to you, and you must take a very strict equity management approach to trading. I'm going to read this out to you, and I know you can read again, but finding a good entry to a trade is not difficult if you're patient and disciplined and have a sound understanding of the market. However, using proper equity management and trade management seem to be an insurmountable challenge to most novice and intermediate traders. And believe it or not, a lot of professional traders also will slowly shift out of good equity management. The objective to trading profitably at a controlled pace, allowing your equity to grow steadily without any major setbacks that are typically inspired by irrational trading decisions. The account will grow seemingly slowly at first, but as you make progress and begin to increase your position sizes, as your equity builds, and as you apply good disciplined equity management, you'll see the compounding begin to have a significant impact as time goes on. And that's when you become a very, very profitable and exponentially profitable trader. So think about it. If you risk 5%, you can lose 5%. If you risk 1%, you'll only lose 1%. So how good a trader are you? Are you good enough of a trader that you can even afford to risk 5%, which even the most experienced traders don't risk 5% or shouldn't risk 5%? But if you lack skill and risk 5%, you won't be around for very long, and I'll tell you that right now. If you lack skill and you lose 1%, you'll be around long enough to make the necessary changes in order to make the adjustments to become profitable. When you become profitable, a nice steady growth in your account and, more importantly, in your position sizes in relation to your account, it'll become very rewarding because you'll now have a command over the market and over your equity and over yourself with discipline. Let's look on some examples. Let's look at some examples. Scenario 1. Say you can afford to open up an account for $20,000 and you decide that you want to risk 0.75%, which is equivalent to $150. You take a position size of 5 mini lots because it allows for flexibility in your position management. That way you can take profit at certain levels and manage your trade accordingly and maybe leave a little bit in to trail stop in case the market decides to keep running. You risk 30 pips. 5 lots times 30 pips equals $150. Your risk is 0.75%. Anytime that you start trading an account, you have to assume that you will take on 10 consecutive losses. So if you take 10 consecutive losses at 0.75% risk, you will lose $1,450. So your total drawdown from 10 consecutive losses is 7.25%, or 7.25%. Now, what if you took 2 losses at 5% risk? You would be well below the 7.25%. What if you took 10 consecutive losses at 5%? Then what happens is you start to draw on what's called your mental capital. If you draw on your emotional and mental capital, then it becomes very toxic to your system and begins to affect your psyche and your trading discipline and your rational view of the market. Scenario 2. Say that you open up an account for only $10,000 and you decide to risk 0.9% or $90 on a trade. You can afford to take a position size of 3 mini lots, and 3 mini lots still offers flexibility for position management. Maybe after 20 or 30 pips you take out 2 lots and maybe leave one in case the market decides to go 60 or 70 pips that day. With a risk of 30 pip stop, 3 lots at 30 pips is $90, which is 0.9% risk. If you assume that when you start trading the account you're going to experience 10 consecutive losses, you will lose $864. Your total drawdown from the 10 consecutive losses would be minus 8.64%. Can you live with a drawdown of 8.64% or $864 on 10,000? Sure you can. You not only have mental capital to continue trading, but you also have your asset capital to continue trading, and you don't begin to make any irrational decisions hoping that you can make it all back in one trade. Scenario 3. Say we have an account size of $5,000. We risk 1.2% or $60 on a trade with 30 pip stop. You take a position size of 2 mini lots, which still allows some flexibility for position management, but fairly limited. If you're risking a 30 pip stop on the trade, 2 lots times 30 pips is $60, which is a risk of 1.2%. Consider the scenario that when you start trading the account, you endure 10 consecutive losses, or a total account size loss of $568.60. Your total drawdown from the 10 consecutive losses would be 11.4%. Can you live with a drawdown of 11.5%? Will your spouse be angry with you if you draw down by $568 or 11.4%? Do you have enough money left to change your habits, to stop making the decisions that you had been making to create the drawdown, and now follow the rules? Scenario 4. This is a typical scenario for many novice traders, and I may be speaking to you. Say you open up an account size of $5,000. And it's not exact, but again, speaking conceptually. You decide to risk 6% on the trade, or $300 on the trade. You take a position size of 10 mini lots, or one 100K lot. You risk 30 pips on the trade, or 30 pip stop. 10 lots times 30 pips is $300. Your risk is 6%. The first 3 trades are winners for a profit of 18%. So greed tells you to increase risk and position size because you're a good trader. Your first 3 trades were winners, right? Then the next 6 trades at 15 lots and 30 pip risk are losers. 15 lots times 30 pips equals $450 times 6 losses is $2,700. The $2,700 represents more than 50% of the original account value, including the profit on the previous trades. $5,900 minus $2,700 now leaves you with $3,200 of available equity. So you've seen your account draw down from $5,000 to $3,200. After 3 wins and 6 losses, you have a drawdown of 36%. Then you say to yourself, what the hell? I have to make it back, so I'll risk more on the next trade. Is that rational thinking? After all, I'm due for a winner and it can't get any worse. So now, by this line of thinking, which you only share your thoughts with yourself when you're at your trading desk, it is only you and you sitting at your trading desk. And you know what you're thinking, you know how you're rationalizing, you know the manner in which you are applying logic to the current trading environment, logic or illogic, and trading is one environment where you can't cheat yourself. You can cheat yourself when there's food on the table. You can cheat yourself at other places where you work. You can cheat yourself with exercise, but you can't cheat yourself at the trading desk because the market will grind you down. And it will grind you down because in every trading career, you will experience at one point, you will experience 10 consecutive losses. I don't use definitive affirmatives like always, never, absolutely, will do, won't do, but you will at some point experience 10 losers in a row, and you have to be prepared for it. And I'll tell you that there are a couple of occasions where I experienced 10 losers in a row. I have different strategies around as I start to near the 10 losers in a row, I scale back on my position sizes and so forth, because it becomes more or less more about the success and the management around the trades as it grinds you down. But my largest and most significant profitable periods followed my largest strings of losses. And if I had allowed irrational decisions and overexposure of equity in my protocol during that period, I would not have been around to watch my most profitable periods make back the equity that I lost in a very short period of time, typically 1/4 to 1/3 to 1/2 of the time, making back the equity that I lost before making new equity highs. And you will experience 10 losers in a row at some point, and you're likely to experience a string of losers when you start trading, and you want to protect yourself from that because you want to be alive long enough to allow this business to change your life. Okay? And please heed this advice. And as we get into the trade management and ideal entry lectures, it's going to be more about being steady over time rather than hitting home runs. What stop size can I afford? Well, what is your equity? What is the size of your account? If you have an account size of $20,000 and you're risking 1%, you will be risking $200 on the trade, which would be your stop size. So what is your trade size? 5 mini lots. If you have a stop size, to establish your stop size, if you can afford $200 risk on the trade and you're trading 5 lots, you will have a 40 pip stop loss for the trade on that position size using the above parameters. The other way you can do it is you can establish what the size of your risk is, and then I've got a spreadsheet where we establish the size of the equity that we will risk on the trade, and what it does, it tells us what position size we can take in relation to the stop that we'll use and the equity that we'll use on the trade. But I can't get rich quick with that kind of equity management. If you want to get rich quick but lack discipline, you'll probably only get poor quick. The idea is to slowly build your account, and I tell you, it builds. If you're steady over time, it builds, and then as you begin to take larger position sizes, then your account will grow exponentially. If you trade without discipline, experience is what you have left after everything else is gone.